Hey, greetings, Dr. Jeffrey Scott here. This is my weekend market update for the week ending Sunday, April 20th, 2025. Compared to the last several weeks, it seemed a little bit quieter. Um, but we had a lot of days where we closed lower than we opened, except for perhaps on Thursday, sorry. Friday was Good Friday, so the market was not open. We have death crosses on multiple indices, and the question is that the end of the beginning or the beginning of the end of the bear market or market that we're in? Again, my name is Jeffrey Scott. Email address is hgsidoc@gmail.com or marketmripro@gmail.com. For all the negative that is said about death crosses and just the connotations of the word death, you might be surprised what happens after a death cross. As always, this is for educational purposes only. Anything I talk about should be taken in the spirit of education and not investment advice. The intent of the video is to demonstrate the tools of top-down investing and how I apply them. Trading involves risk. You alone are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock mentioned in this report. Trading stocks and options should be considered risky, and you should consult with your financial advisor before making trades. And I have tools in multiple platforms, but am an independent trader. If you're looking for my wealth charts video, it'll be here, but it'll be at stocksanddocs.com before the market on Monday morning. Orange County meeting is on and filling up. It is 300 per person until May 1st. Then it goes to 400. Residence Inn and Suites, Tustin, Orange County. For more information, Greg mails at gam72054@aol.com. Speakers to be determined, but right now I've got commitments, hard commitments from John Person, from myself, from Chris White. I'll be live. The other two will be zooming in. And it looks like Dev Keshov will be speaking as well. And Matt Caruso, at least his team, has said he would speak. If that's it, that's a pretty great group. Looking forward to that. Once Matt confirms, I'll be more committed on his name. If you like these videos, you want more interaction, why don't you join my Google group? It's called Top Down Traders, separate words. It's free. I have no plans of ever charging for it. It's where I put videos when I don't post them anywhere else, where if I see a market changing in the middle of the day, I may actually call out so you can be aware of it. And I give discounts on my tools for people that want to buy them. Is there a recession in the near future? And so I look at certain things. I look at the 10-3 and the 10-2. And we all know, because I've said it every week for years, that after we go below the zero line, after we cross back above, we are at risk of recession. Each time going back to the 80s, where this has happened on the 10-3 month or on the 10-2 years, going back before the 80s actually, we get a recession. So we have crossed back above it. On both of these, we've double dipped a little bit on the 10-3. What does that tell us? It tells us that we run the risk of a recession. It's not magic, but it doesn't tell us when that recession is going to occur. We've been above it now for a while. The tariffs seem to be heading us towards a potential recession, and so something that I think is real, but it's not here yet. And therefore, I'm not trading like it's here yet. But if we do get a recession, a bear market in a recession can be much worse than what we've seen to date. Now, ignore this for a second. I put it in the wrong place. If you look at the Fed Diffusion Index, it took a dive, and it closed, and this came out this past week on the 17th at minus 26.4, well below expectations. Why is that important? Because not every time we got below 20, because we got below 20 back here, but most of the times we got below 20, that's what was about the time we got the recession. Makes sense. Recession, the employment the manufacturing activity, the purchasing all get lower. You'd expect the activity by the Federal Reserve that it observes to be lower. So that is concerning and new. And I put this in the wrong place, of course, but this looks at the Bank of America high yield index option adjusted spread. The point is it will spike into a recession. And what this is showing you is even though it doesn't look like much here, if you go into a shorter time frame, we actually got a little spike, but it's already coming back. So the evidence is getting louder. I still don't see us in a recession. I think the risk by most metrics is higher. Doesn't mean we're going to get one, but I keep it on my radar and not forget that. Know your news and earnings. On the left are arrows representing Fed speakers. Powell's not speaking, but you know Goolsbee is speaking, among others, and Kashkari speaking. So one could expect the market to get whipped a little bit by this. I think what the market wants to hear are more comments that juiced it a couple weeks ago, which were the Fed's here if the economy falters, the Fed's here if the tariffs get us in trouble. But what we heard this week from Powell, which didn't help the markets, is there's no Fed put. On the right-hand side, as it says here, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. We are going into a big week of earnings, and there are some humdingers. Tesla on Tuesday. Tesla's taking it on the chin. Will they have good news? We've seen their sales have dropped both in the U.S. and in China. On Wednesday, IBM, ServiceNow, AT&T. Thursday, you got Intel, Alphabet, T-Mobile has been a big mover. Some of the gold stocks are popping up, more airlines. Then AbbVie as a pharma stock coming in on Friday. So a lot of things that can move the market this week. So the question I started with is this the beginning or the end or the end of the beginning of the bear market? This is a chart looking back to 1981 from Dow Jones, and it's looking at the S&P 500 performance after the last 20 death crosses. A death cross is the 50 crossing below the 200. I agree with many that say that is a lagging indicator. It takes time for that to show up on a chart. By that time, are we almost done with the pullback? And I think that's how I feel. So if you look at this, you can see 1 week performance is mixed. Average is up 0.1, median's 0.6. Markets are positive 55%. A month after the death cross, similar. 0.2 up, median 2.2, a little bit more than half were up. But if you start looking at 3, 6, and 1 year after this occurs, you are starting to improve. So if we just take the odds, we're going to be higher a year from now. That's 80%. No one knows that for sure. 80% is not 100%, but it suggests to me that perhaps we're closer to the end of this pullback rather than the beginning. On to the charts. Don't forget my Google group, Top Down Trader. And then California in June and maybe Florida or Vegas before the end of the year for the next seminar. All right, let's look at my Market MRI Pro and see how fast I can take you through the markets. If we rank by 1 day close, you can see the market was led on Friday, or Thursday rather, by the Russell. Spider 0.14, the Q's flat, Diamonds down 1.36, and volatility was down 2.75. If we look over here, only the Russell closed in the upper part of their daily range. Even the VIX volatility closed near the bottom. Now, it was a 4-day week, so I think this is probably going to reflect 5 days in the market. But you could see the Russell over the last 5 days up 2.67. So the small and the mid caps have actually started to outperform. Now, it sounds good if you're in small and mid caps, but reality, all the stocks in the Russell 2000 don't have the market cap that one of the $3 billion stocks has. So $3 trillion stocks. So yes, small caps are leading, but I'm not sure that's that meaningful. You could see over the 5 days, the Qs are down 0.5%, diamonds 1%. So clearly a shift to the small cap Russell. If we look at S&P 500 sectors on Friday, energy, staples, real estate, utilities. So even though the markets appeared to broaden out a bit and the markets were overall, especially small caps, were higher, it was led by defensive instruments. Not defense, but defensive instruments. What lagged? Well, healthcare was dragged down probably by United. Tech, financial, industrial, discretionary were the laggards, all those down more than 1%. So the things that you want to be leading the market were lagging. That's never a good thing. If you look at 1 day change, it's like static electricity. You can't get rid of it if you try. Every time the market's bad, cannabis comes up to the top in 1 day return. It had a good 5 days, but when you look at it over 50 days, it's down 31%. Oil, retail, we're up at the top. Norway, video games, transports, interestingly, home construction, rates must have been down. Data centers, blockchain were on the top. And if you look at where the laggards were in the market down on the bottom, 1 day change, interestingly, gold miners and silver miners, which is bizarre because gold has been so strong. Maybe some profit taking, semiconductors, not surprising, cybersecurity, cloud, tech software, cybersecurity, internet. So a lot of the tech names were laggards. These are themes. Here are three of the major indexes that I like to watch: S&P 1500, the NASDAQ, and the NYSE. At the top is the number of sectors or percentage of sectors that were up on the session: 36, 50, and 45. So the NASDAQ led there. And you could see that underneath these blue lines are minimal smaller lines, so much stronger than the prior session. Industry groups, 41%, 41%, 44%, so about equal. So about 43, 44% of the industry groups in each index were up. Advances, 42, 38, and 45. That's disappointing. Less than half the stocks were up. So even though it felt like a better day to me, I guess I must have some small cap names. When you look at it like this, it's not even a 50-50 day. So weaker than it appeared as I watched the market during the session. Now, if we look at the buckets, you could see a clear shift to the left, meaning we've started to pile in the areas at the bottom of the Bollinger Bands and below. We've gone up to 33% stocks in the NYSE below, 36% in the 1500, 40% in the Russell 2000, and 39% in the NASDAQ. So it was not a good day, I guess, for the average stock. You know, I have a tendency to be focused on my portfolio. I just got a few names. Now you can see over here that there were some winners. Some stocks moved up to the top and even got above. So you could see the gray, thick gray bar, that was the day before. You could see both of these got lower as stocks shifted to the below the Bollinger Bands. But actually on several of these, we saw improvement at the top of the scale as well. So that's interesting. So we have some stocks that did okay, but overall the market's weakened. That's interesting. I like to look at market breadth, get me a sense of what's going on underneath. On the left is the NYSE, on the right is the NASDAQ, and you can see we have both come up nicely off of a low. And if you believe in Santa Claus and the Easter Bunny and miracles, maybe we're in a V bottom and we're heading higher. I kind of think we're probably not, and we'll talk more about that as we go. Here is the death cross on the NASDAQ, not quite yet on the NYSE, but you'll see more in a few minutes. Volume has been receding, no surprise. Down here in white, we're looking at stocks above the 50, in green, stocks above the 20, and in red, stocks above the 200. And those have improved steadily during the week as we moved up for the most part. If you look over here, these histograms, remember left NYSE, right NASDAQ. The first histogram shows you new high, new lows that are negative on both. You can look at advanced decliners, which were actually positive. and up-down volume was positive. So I'll call the internals mixed, and no new signals came up. One thing I didn't point out on the daily briefing, up here it shows us new highs minus new lows at 4 time frames, NYSE and NASDAQ, and we're still pretty negative on those at the different time frames. And hence, on the market breadth, the new high, new lows were still negative. All right, what else are we going to show you? Let's go to the timing brief. This is the weekly charts. This is my main model for timing. I look at this bar on the bottom, simple model. I have an indicator that I created with a couple of my buddies 20 years ago called the bongo, which is a trending indicator. And I look for two signals. Is my bongo red or green, in this case blue, negative or positive, and my price above the 30 period WMA. Since it's a weekly chart, it's a weekly WMA. The first day, we could go down here, that both occurred at the same time would have been right here. This day did not close above the WMA. And the bongo turned, on this week, the bongo turned blue or green, closed above it, you went into a buy signal. This is the S&P 500, where we went long from November 6th all the way up to here, and we didn't change until January 8th of 25. So a year and 2 months we were long this market. It's been very good over long periods of time. During choppy markets, it will drive you crazy, as will most timing models. We are clearly in a sell signal as by this line here, here, and here on the weekly charts. If I look at the daily charts, you could see that that WMA is like a blanket over the indexes. We are in a sell signal on all the dailies, so we are in a downtrend. Now, the first thing that's going to change is the dailies are going to go to an uptrend. And if that uptrend is more than a retracement and a downtrend, maybe the weeklies will change. But we haven't started towards that yet. This green line represents the 13-week new high and lows, and there's really no signal here to speak of. If I look at the index charts, just to look at, step back of what we've been talking about, this green line here is the 17-day moving average, and you could see on the daily charts, whether it's the spiders, whether it's the Qs, whether it's the diamonds, or the Russell, it is the current line of resistance. And until we break above that, there's nothing good about this market, in my opinion. Now, the problem is, even when we break above that, we're going to have this trend line, which has come off of these, but I've got the same trend line on these three. And if I put on a 21-day exponential, it's just a little higher than the 17 will actually capture these breaches of it. So you've got short-term resistance at that 17, then you've got resistance here, and then you've got resistance up here at the 200. Notice that on the spiders, within the last couple of bars on the daily chart, the 50 crossed below the 200. The Qs, the 50 through the 200. The diamonds, since I can see white below, the 50s crossed below the 200. And let's look at that. All I got to do is highlight the bar. Come on. 200's 422. 50's 421. Yep, the 50's crossed below. The Russell's happened a few days before. So you can see each of these have a death cross. I don't think the death cross means the end of their lives. I think I'm a believer that most of the damage is already done. However, no one says we can't run up to this and fail and go lower. So I don't think we're out of the woods yet. I still think retests happen, and I'd rather go higher because I still have some long-term longs. But in my mind, we're in a downtrend. We were traced. We're struggling. We're going to come back further low. I think, to me, is the most likely thing. It doesn't mean that a year from now we're not much higher. If we look at the VIX has come down. If we look at the dollar seems to be bouncing around at recent lows. Kind of an area that it pulled back into December of 23. If we look at commodities, you're going to see gold and silver have been on fire. They both didn't do much on Friday. Excuse me, Good Friday, so Thursday. Oil's making a move up. I'll believe it when I see it, but some of the more impressive stocks in the market were energy. This was up 2.5%. Natural gas, looking to put a bottom in at the 200. And we could see here that both the 10-year and the 30-year, at least on Friday, were actually higher. And if I flip this to a weekly, take a look at what we get here. You could see the move that gold has been in. Silver, not as strong. Oil trying to make a comeback. Natural gas pulling back. On the week, the 10-year and the 30-year came back a little bit. So that's the market. So my overall feeling is we are in a downtrend. We had a retracement. Don't know if the retracement's going to do anything more and break higher. I think gravity says it's going lower. And a retest would not be out of the question. But I have to take the market every day and see what it gives me. And I've learned not to get fooled by the futures, which have not always reflected what the market's done at the close. If we look at the ratio charts, I can start to look at what's working now. And these are a bunch of S&P sectors except for this guy, which is Bitcoin. And then they are put in ratio charts versus the spiders. So it's a relative performance. Defensive stocks like Staples, Staples, utilities, real estate, and not so much healthcare, doing very well. XLB doing well. Energy's coming up. What's not doing well? Discretionary and tech. Even industrials look pretty good. So some rotation out of tech continues. And I know you've seen that if you're owning any of the Mag 7, 8 type stocks. Now I end up in my favorite layout, which has got my initials, the JAS layout. So a couple of comments I want to make for those people that are still here. We are finishing up one of my favorite educators and friends, authors, traders, money managers, John Person's add-on for this product. The business model to be determined, but it will be a second purchase, or if you don't have my product and you don't want my product, you just want John's product, that might be an alternative purchase. But we're working on what that will be. I've got the beta version. It is awesome. I think I can probably give up TradeStation, but don't tell them that, because that's the one thing that I still really that and Sagar's tools on TradeStation and Metastock. But that I'll have more to say soon. In fact, part of why I want John to speak at the June meeting is that's probably when we'll officially launch it. Very exciting time. The other thing is I am going to plan on doing sometime around May, I'll tell you the date here, around May 3rd, I'm going to do one of those crazy 3.5-hour educational programs on top-down investing, how I use the various tools, mine and other people's tools. More to follow. I'll send the invite first to Top Down Trader. I've got limited spots, but then I'll post it on YouTube to fill up the rest of the spots. There's no charge. I will offer for sale again at that time my package on Market MRI Pro, as well as my tools for TradeStation and TradingView. We introduced Market MRI Pro, had a flurry of sales, and then intentionally shut them down so we could assess how many more servers we needed to add and get some of the potential service issues that stressing the system could cause out. We're good there. I've got an update coming to those that own the program, so include it in your purchase, which will be more indicators, traditional indicators, how to create your own charts, and the ability to expand what we do. So very exciting times with Market MRI Pro, and we'll be following up with you about that shortly. So JAS layouts where I do my work on sector, industry group, and stock analysis. So let's just go into start with the JAS Impulse. So this is going to be 3,393 stocks. Who are these stocks? They are components of the NASDAQ, Amex, and NYSE that are filtered for $1 price and 100,000 shares. That gives me a large data set. Now, I don't buy and sell stocks that are less than $5 and 500, but from the purpose of scanning and looking for new opportunities and themes, I like to include those cheaper stocks as well. I take all those stocks here, or you could pick the weeklies, the various indexes, components of the indexes, and I put them into sectors and industry groups. It's automated by the program. So this will look different than the S&P 500 because it's the Jeffrey 4000 or 3400. And these are the sectors that they roll up into and then the industry groups. I am a top-down trader, so I might come in here and look at performance of the leading industry groups. And the top three were energy, staples, and real estate. In this program, we call staples consumer defensive, consumer cyclical are the more discretionary. If I then take those three highlighted, these are the different industry groups in those three sectors. Let's keep the theme of percentage and let's rank these. Let's take the top 10. 1, 2, 3, 4, 5, 6. Yeah, I know you know that I know how to count. All right, these are the top 10 industry groups and the top three sectors. There are 215 stocks. Now, I could rank them by percent change, and that's one thing that I do. But typically what I want to do now is I want to filter out the stocks that are less than 5. So all stocks have to be greater than 5 and 500,000 shares. And that leaves me with 133. And then I'm going to do is rank them here by 2-day momentum. And let's see what we find. So the first stock is one that I like a lot here in many ways and not so much in other ways. And that is Costco. And I've got to wake up. There we go. So if we look at a weekly chart of Costco, it was on a tear from really from back here, which is 23, when the market was selling off. It's run and doubled. Pretty big move. It had a big pullback to the 50-week line, which is 250 days, and bounced. What has always worried me about Costco is the fundamentals. Here is the earnings clearly growing. This is the change percentage, not versus the prior, but versus the last third 3.6, 3.7. It was 3.92 up to $4.02. That's only 10 cents or 2.5%. And that is, it was a negative surprise. Here is the revenue growth and then change percent and whether there was a surprise. Again, it's always compared back to the same quarter in the prior year. So I see very slow earnings per share growth, although we did see some surprises. I see relatively slow high single digit revenue growth. And I see a multiple, forward multiple, which in this program says 236. Now, one could check that, and I think we ought to check that, by going into, let's just open up MarketSmith. All right, so let's look at, all right, let me just do one quick, couple things here real quick. First of all, let me close that. Okay. Second thing, let me just bring up this, and let's type in COST, C-O-S-T. So it has a, I guess, a backwards PE of 58. You could see here the earnings per share growth is slowing down 25 and 26. So I find that to me a bit of a red flag. It's slowing down its earnings rates. It's still, whether it's 58 or the forward 120 something, it's still priced high. Then people will tell me that, well, Jeff, you can't look at it that way because it's not just a retailer. I'll admit it's a phenomenon, but they're talking about selling gold and silver. So if I want to be bullish, pull back 200, just broke above the 50. Relative strength is great. OBV is turning up. Only blue dots recently come out of a squeeze. I think it looks interesting, breaking out above the 50, and I'm thinking of buying some. It's not extended. It's only 34.53. That is the bullish case. There's probably a bearish case that you could probably draw this line here and call that a neckline. And are we topping and a break below this, and do we go much lower? So I think this is at an interesting point. I'm not against taking a trade in it, but I probably make it, I probably wouldn't buy it unless it goes above the high of the day. I'd have a stop, probably not, where do you put your stop? I'm not going to put my stop down here. It's way too far. But I probably have a relatively tight stop and be aware that, is this an early head and shoulders? Could be, or it could just be heading out. You could also draw some trend lines here and say maybe it's in a downtrend. Again, if it moves further, I think it might be interesting to look at. FANG, this is what a lot of the energy oil producer stocks look like. Certainly doesn't look like a growth stock. You're certainly not buying a breakout. You're buying a beaten down stock. But this is what happens when you rotate into things that have been laggards. Vista, another one, a little bit better. Dollar Tree. So Dollar Tree is another one, and Dollar General, which follows, that I thought was interesting. And maybe in the Costco vein, this is a shifting to lower quality stores in the setting of a potential recession. You could see a breakout above the 200. Relative strength and OBV look good. You had a breakout, momentum breakouts, and a CPR. That looked interesting. Dollar General, again, the same theme. Are we shifting to lower quality assets and under purchasing? Break above the 200, a retest, and a beautiful move on Friday with breakout and momentum. So those three moving at the top of the list do make me wonder if I shouldn't be thinking about getting into these mass merchants that are low-cost providers. Procter & Gamble, Consumer Staples, Marathon Petroleum. And this is the problem with the energy complex. These are hard for me to buy. I don't know how to buy things like that. I know how to buy things that are doing this, pulling back, basing, and breaking out. I know how to buy them. I'm just saying it's not my type of stock. Kimberly Clark is another staple. Cord Energy, way down. EOG, way down. Colgate Palmolive. Now, if I want to be in this land of consumer staples, doesn't necessarily look bad either. And that might be, some, again, a breakout above the 200. It's a safe place, perhaps, if the market pulls back, we have a recession. Integrated don't look great. Weatherford, a oil services stock, doesn't look great. First Solar. So I'm always troubled when the market is doing this, and as I look through, I see just a lot of damaged stocks. Now, if we like those others, do we like Walmart? Well, actually, before I go to Walmart, look at Halliburton. Great stock. But boy, what a downtrend. At some point, it's going to reverse. Is it now? It might be. Just it's hard for me. Unilever, this is one that looks great. It's gappy because it's a ADR. Uptrend, pullback, and now a new breakout. Again, if you believe the market's going lower and we're going to have some economic concerns, consumer defensive or staples are a good place to be. And here's another one of those mass lower cost retailers. Here's Walmart. Broke out, came back and retested, had a positive session. And I think that one looks interesting as well. So if I was a top-down investor purely, I might stop right here. There's another one that's in the staples space that I was looking at. I mean, how sexy not is fresh Del Monte. I think of veggies in a can. But big uptrend, pullback, and a breakout. If this was a growth stock, we'd be all over this like flypaper. Relative strength looks good, OBV looks good, coming out of a squeeze with some breakout signals, not extended. I like FDP. So those were some of the things that I saw that looked good from the perspective of top down. Now, sometimes I can't help myself, and when it comes to that, it means I'd rather be looking at bottoms up too and see if there's anything that's going to stand out. So I've left on the 5 and 500 since I want to look for longs because I think we might be at a point that we could reverse higher. Again, I still think we're going lower. I think anything higher is going to just set us up to short at a better point. I do think we get a retest. Don't know that for sure. I have no crystal ball. I'm just prepared for that line of thought. So let's look and see if I got any 2-day momentum signals. This is my favorite one. It's been very good to be trading this one for me over time. Come on. Here we go. ALTS. I don't think that was a good one. Let's see. I mean, I don't know anything about this. This looks like death with a little hiccup. Could be a lot there. Let's just look at it here. Crypto as a service offering. Not enough for me. Anabis. A-N-A-B. So I don't like buying things that are below the 200. There are people that say nothing good ever happens below the 200. I do think that we're getting overdue a move on healthcare. And I kind of like what I'm seeing here is we've got higher lows. If we could take out this high, we'll have higher highs. ANAB, I might be watching it. Now, one of the problems is it's only got 20%, 15% move into the 200. And ATEC, Alpha Tech, not my favorite healthcare stock. Let's look at this under monthly. You may probably see why. There you go. It ran up during pandemics. It ran up with the Ebola scares because they make things for healthcare professionals, gowns, gloves, masks, and others in the setting of contagions. But unless somebody knows we got an Ebola attack coming soon, probably not where I want to put my money in. So of the three of these, the ANAB looks the most interesting. Let's kill that one. And let's take a look at another one of my signals. Let's look at the multi-time frame CPR. And we got a lot more of these 85. Let's rank them by FM2 because that's the 2-day momentum is how I like to do it. Let's just go through the list. Costco, we already talked about it. Fidelity National Information Services, they had a transaction. They sold something, I believe. Strong momentum stock. That was on the 18th. Yeah, it doesn't tell me too much about it right there. But again, except for the fact it's above the 200, you kind of got a nice little base put in here. Not very long, but at least for a month, month and a half. And now we're breaking out. So it's kind of interesting. Don't like the 200 right above it. Dollar Tree we already talked about. Huntington Ingalls. A couple weeks ago, a lot of the defensive stocks made my list. Not as many this week. They make aircraft carriers. You got a big gap to fill. You got the 200. It looks okay, but get above the 200. Master Charge. If you were really bullish this market, you can see a pullback here at 200. It looks attractive. You got a CPR and a breakout signal. There's Procter & Gamble, Kimberly-Clark, Clorox, Colgate. These are all consumer staples. ExxonMobil, Integrated Energy. They're just not great looking patterns. Uber, maybe. Uber has taken out its 50, It has a CPR. It had a breakout. Relative strength and OBV look good. It's not extended. You can probably take this thing. I want to leave it there. There you go. And say it just broke out of that flag. This kind of kills the idea that it's a flag, but it's a fresh breakout. So Uber looks kind of interesting. Pubmatic, no, no. Waterford just so far down. FE was one of the utility plays that looked interesting. I don't love it. Pays, I think, about a 3% dividend or so, something in that area. I mean, a breakout above that, I mean, it's boring. AER, industrials, sideways. Darden restaurants, some of the restaurants looked interesting. Coke, another staple, out at, if not all time, multi year highs. Apartments, alcohol. I mean, am I showing you great charts? No, I'd be stopping and talking to them if they were. These are just new stocks that are moving that met our criteria. So let me review a couple more things. Here are some of the stocks that I liked, and I'll just go through them one more time. Costco. I think Costco is, my guess is it goes back to retest up here. I want to be involved in it, but I'm equally aware that we could be setting up a head and shoulders. So I'll have tight stops. I like Costco, and I may enter a position on Monday. That doesn't mean I'm buying it. I said I may. This is not advice to tell you what to buy. This is purely um, education. Dollar Tree I kind of like because it's breaking above the 200 here. So that one looks interesting to me. Um, DG, Dollar General, in the same basic space. And I assume they got killed because of all the tariff talk. But this one actually came back and retested. They look very similar to me. Um, I think it's a boring as heck name, Del Monte. But if staples are working, uptrend, pullback, and a breakout. When are earnings coming out? Earnings are not out. They're out soon. They're out in 11 days. Again, it's boring, but the chart pattern looks good, and sometimes that's what matters. GEO, try to get that again. GEO, I think they do some kind of mapping for, no, that's GEOS. That's not what I want. Never mind. GEO. Big move up, sideways move. Let's not make sure it's not part of a takeover. Oh, surveillance tech. They help miners. I thought they helped energy providers too. All right. Um, Basing looks like it's breaking out here. Nothing against it. Is it great? No, but it's not horrible. Boy, that's really tells you the state of the market. I'm showing you things because they're not horrible. MicroStrategy, now called Strategy. If you believe Bitcoin's going higher, this is a leveraged way to play it. Um, let me just try that again. This is one that has a bit of a technology play, an old technology that sometimes surprises on the numbers that uses its underlying company to raise debt, and it uses that debt to buy Bitcoin. So it's one of the unusual leveraged ways to buy Bitcoin in the US market. I think a break above this top white line, I think MicroStrategy could be interesting. TATT is also in defense. Don't know anything about it except the chart pattern was interesting. And here you can see why. I've showed you all these lousy looking charts. Big run up, pullback, and a new fresh breakout. And I bet that's long-term highs. Let's see. I think that's looks to me pretty darn good, huh? Highs for going back at least 10 years. TATT, I didn't think they were around that long. Um, this may, well, I don't know. I was trying to figure out if this is sometimes what happens. Let's go back to the daily. That's what tell me that if it's the truth. Sometimes in our program, something will, just watching the dates. No, no, I guess it's been around for a while. All right, TATT. I feel a little bit better about it when I see how long it's been here, but a pullback and a breakout, not overly extended. It's getting there. Look at the massive volume, maybe the biggest volume ever on the stock, going back here to May of 23. Relative strength looks like it's taken off. OBV looks good. So TATT looks interesting. I don't know if this is healthcare or if this is going to be staples. My guess is Chewy, which is stuff for dogs. I think healthcare is because we buy some of their medicine that way. Big uptrend, pullback, a breakout over their 50. People still take care of their animals in a recession. Chewy. And then the last one that I thought was interesting looking, or one of them was EZPW. And you could see beautiful run. Is it extended? Not quite. It's only at 81. So 81 is a mathematical measurement of extension. At 81, I can still buy it. At 95, I don't buy it. In between 85 and 95, I'm careful. So that looks like that. We're at 46 minutes. Let me look at a couple other things. Let's look at some of our favorites that people like to look at. Why is that there? Huh. Well, I thought oh, they probably, I put something in there that, let me kill this. That's the first thing I need to do. So let me take out my filter. Now we should be back to, there we go, 3,400 stocks. Let's just look at the ones that everybody unfortunately still owns. Hopefully you don't own too much. Amazon, where is it likely to bounce? Let's go on a weekly chart. Let's put a line at that prior low. Is that our target where the 200 is, 150? If you got down there, I'd probably be buying a lot of it. But Amazon, like many of these stocks, sold off hard, is now got that blanket of the 17-day as well. APP, this was great on the way up. Interestingly, look at where it's pulled into now. Not only is it on the 200, look at where the low was. It pulled in where the gap was. So is it going to hold that gap and run from there? These are all fallen angels. Google can't hold above the 17, well below the 200, death cross. Meta, no death cross yet. Can't get above the 17, broken down below the 200. Microsoft had a rally here, failed at the 50, came back down, death cross. Netflix, the big leader, had a big move on earnings. It'll probably go higher on Monday unless the market sells off in general. But earnings came out Thursday and they were very well received by the street. I think Netflix is going to lead right now. Nvidia, every time you think it's making a recovery, something happens like Trump saying you can't ship your chips to China and you take a $5 billion write-off. And then Tesla, earnings out this week. It'll be interesting to see if earnings can save them. I doubt it. So let's just put it all together. Markets are in a downtrend. My timing model says we are downtrend and we're done retracing. We're probably going lower. However, this market is governed by tweets and tariff talks. And if something happens between now and Monday morning where they announce 5 new deals to 0 or low tariffs between us and whether it's Vietnam, Thailand, Malaysia, Japan, if something else comes out besides one place of questionable source that said secret meetings between China and the U.S. on tariffs, Imagine if the news flow, which already has stopped getting worse and worse for the most part, starts getting better. You could see dramatic moves higher in the indexes and everything on this board, even stocks like Tesla that are in a world of pain. So right now at 2:51 on Saturday, April 19th, barring any other news flashes, the market looks to be going lower. I'd be careful to the long side. Um, you know, would I be shorting this market? I never saw what I saw today, and I'll just pull it over here. Yeah, it's good. Probably won't work, but let me just show you something on TradeStation. It takes a second, especially when I have all these things going on. God knows what this is doing to the movie. And and I don't know, maybe it's an error, but every stock has an HB on it, hard to borrow. I've never seen every stock being hard to borrow. So let's just out of curiosity, Microsoft, MSFT, hard to borrow. Amazon, hard to borrow. Tesla, I don't know, maybe there's a flaw with TradeStation, but it's hard to borrow on everything. Does that mean every stock out there is already short? And does that mean the market's going to rally? Maybe that's a contrarian. I think it's a time to be careful. And if you want to be short the market, there are certain things out there that you can short. Let's say you want to be short the Dow. You can look at, for example, the dogs. The dogs will go up as an ETF when the Dow goes down. So you could go different leverage amounts, but this is the dog. It goes up with the Dow. If the market's crashing here, the dog will go up if the Dow goes down. If you want to be short the Qs, it's easy. S, Q, 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 Q. Big run up, it came down as the market stabilized this week. The Russell was strong this week, but if you think it's going to go down again, you buy TZA, which will go up as the Russell goes down. You can see it was running up, but the Russell led this week, so it came down some. If you like semiconductors to the short side, you can buy SOXS, which is a short semiconductors. Now, it was doing well until you had a couple days of the market rallying. So there are ways to play the market to the downside. My concern right now, I do think there's a chance that we take an assault on this line. And again, the news could be the driver. I still think we end up going lower short term. Who knows? I know I'm all over the place because, geez, this is not an easy market to call. Have an awesome week. Hope I didn't bore you with my long-windedness. Think about coming to our live meeting where we break out everything I showed you, show you where the stuff came from. On my long webinar that I'll be posting shortly, invites to, I'll go through multiple different programs, not just mine. Have a great, great, great rest of Easter weekend. Be safe, travel safe. We'll see you on Monday.